Hello viewers, welcome to my channel. I'm Hasham. In this video, I'm going to explain you the theory of process costing, the topic under the subject cost accounting. Already a number of problems I've solved on process costing. You can visit the playlist of my channel, select the subject cost accounting, under cost accounting problems on process costing. So in this video, briefly I'm going to explain you the meaning of process costing, what are the features of process costing, what are the losses in process costing. Because in examination you may get a theory question regarding this process costing. That's for that purpose only I'm making this short video only on theory of process costing, so that you can be able to write in examination with confidence the theory of process costing. So first of all, process costing is a method of costing which is applied in those industries where goods are manufactured in different stages of production. In different stages of production, the output of one process will become the input of the next process. Like this it goes on until finished product are produced. Simple example in case of sugar manufacturing. In case of sugar manufacturing, the main raw material is sugar cane. The sugar cane is introduced in the first department, first process. It will be crushed and converted it into juice, liquid form. That liquid form will be passed on to the next process, second process. So the output of first process will become the input of the second process. There again some processing work will be done. Then after that it will be converted from juice form into some solid crystals form. So after making that crystals, it will be transferred to the next process number 3. It will become the input of process number 3. It will be crushed and produced into minute particles. Then that minute particles will be passed on to the next process, process number 4, where finished final sugar will be produced. So in this case of manufacturing of sugar, the goods are produced from different departments, stage 1, stage 2, stage 3, like that. The production will be continuous and homogeneous goods are produced. So the method of costing, process costing, will be applied in those industries where the goods are continuously manufactured in different stages. So all the cost incurred will be charged to that process account. So every process account will be treated as a cost center. All the expenses, material, labor will be charged to that process account. If any income is earned by sale of scrap, that will be credited to process account. And the output of one process will become input of the next process. That is the process costing method. Now features of process costing: first, production is continuous. This method of costing will be applied only in those industries where production is continuous. Goods are continuously produced for stock. Second, units produced are standardized and homogeneous. There is no differentiated products produced. All the products are homogeneous, identical in nature. There is no differentiation in the production. Each process is a cost center. That means every process account will be treated as a cost center and all expenses will be charged to that process account. Then the sequence of process is specific and predetermined. That means before starting the production, the producer must determine what is the sequence of production, in which the production should be done in which department first, then which department next. So the sequence of process should be determined in advance. Next one is the output of one process will become the input of the succeeding process. The output of first process will become the input of the second process. The output of second process will become the input of the third process. Like this it goes on till finished goods are produced. Next, output of one process may be sold or transferred to the next process. In some cases, part of the output will be sold at the process itself, or the whole output will be transferred to the next process. So two options are available. In some cases, the part of the output is sold and the part of the output is transferred to next process. And in other organization, the whole output may be transferred to the next process. Then process may involve weight loss or scrap, which may have some realizable value. In some process industries, the output, there is a loss in weight in the process, or there may be some scrap realized in the process. The scrap may have some realizable value. The scrap may be sold and some cash is realized. The sale of scrap will be taken on the credit side of process account. In addition to normal weight loss, there may be some abnormal loss or gain. Now, in process costing, in process industries, it is observed that there is some normal loss. The output will not be equal to input. Suppose 100 tons of sugar cane are introduced, it is not necessary that we will get 100 tons of sugar. There may be some process losses, and sometimes there may be abnormal loss or abnormal gain. The next one, all the units produced at process are identical and cost per unit can be determined. Because all the units produced are homogeneous, identical. So we can calculate the total cost. If we divide the total cost by number of units produced, we'll get cost per unit. So these are the features of process costing. Now the next topic in this process costing is process losses. It is observed in many cases that the output and input will not be equal. The output may be less than the input. Input, suppose 1000 tons are introduced, the output may be 950 tons. Out of 1000 tons introduced, only 950 tons we got the output. What happened to the remaining 50 tons? It is loss in weight. It is normal loss. The normal loss. The losses are again divided into normal loss and abnormal loss. Normal loss means the loss which is expected. The loss which is unavoidable due to the nature of the material or due to the inherent nature of the production process. So due to the inherent nature of the production process or due to faulty material, normally the output will be less than the input. And it is expected. It is expected. Example, in case of sugar manufacturing company, the sugar producer already knows that 10% of the input will be lost in processing. So if 100 tons of sugar cane are introduced, 10% of 100 is 10. 10 tons will be lost. So 100 minus 10, 90 tons we will get. This is according to our experience, according to our knowledge, that if we introduce 100 tons, we'll get 90 tons output. 10% is lost. This is expected. So it is called normal loss. It is called normal loss. Sometimes this normal loss will earn some scrap value. The credit side of process account, we will take normal loss. Normal loss in units column. If these normal loss units are realizing some scrap value, that value will be taken on the credit side of process account. Now what is abnormal loss? Abnormal loss means the loss which is over and above normal loss. If any loss is incurred over and above abnormal loss, over and above normal loss, it is called abnormal loss. Simple example I will give you. If the sugar manufacturer expects that 10% will be the loss. If 100 tons of sugar cane are introduced, so they should get 90 tons of sugar. That is 10% normal loss. But in a particular period, the producer got only 85 tons of sugar. So instead of getting 90 tons of sugar, actually 85 tons of sugar they got. So 5 tons extra loss. 10 ton is the normal loss. Extra 5 ton is the loss. This extra 5 ton loss is called abnormal loss. In simple words, I can say abnormal loss is the loss which is over and above normal loss. The formula to calculate the value of abnormal loss is normal cost by normal output into units of abnormal loss. By using this formula, we can get the value of abnormal loss. The entry for abnormal loss is abnormal loss account data to process account. So abnormal loss account will be debited and process account will be credited. So in the process account credit side, by abnormal loss we will take, right? The abnormal loss will occur when actual output is less than the expected output. Actual output is less than the expected output. The expected output 90 tons, but we got only 85 tons. So 5 ton is the abnormal loss. But abnormal gain doesn't mean that actual output is more than the input. The output will never be more than input. If we introduce 100 tons of sugar cane, we can never expect that we'll get 120 tons of sugar. When we are introducing, we are making input of only 100, so we may get 100 or less than 100. How come we can be able to get more than 100? It is never been possible. So abnormal gain doesn't mean that the output will be more than the input. Then what is an abnormal gain? The actual loss is less than the expected loss. The actual loss is less than the expected loss. Simple example, the sugar manufacturer expects that 10% is the loss during processing. 100 tons of sugar cane are introduced, 10% loss, so actual output should be 90 tons. Actual output should be 90 tons. But in a particular period, we got 95 tons of sugar. Actually, we should get 90 tons. But during a particular period, we got 95 tons of sugar. So this 5 tons extra we got the sugar, that is called abnormal gain. The formula for abnormal gain is exactly same as abnormal loss. The value of abnormal gain is equal to normal cost by normal output into units of abnormal gain. Normal cost of normal output into units of abnormal gain. This formula will give you the value of abnormal gain. So the journal entry for abnormal gain is process account debtor to abnormal gain account. Process account debtor to abnormal gain account. The process account should be debited, abnormal gain account should be credited. That's all. So this is the brief explanation about the process costing, so that you can be able to write the theory question in examination confidently. So if you are satisfied with my lecture, give a like to the video. Share it in your group, in your friends, so that more students can watch the video. And lastly, subscribe my channel if you have not yet subscribed.